Stocks trade in a range with advances and declines almost balancing out as earnings season draws to a close and investors wait for fresh cues. Like the US CPI print later this week, the mid-caps, they outperform in trade today.
After a stellar post-listing performance by Ola Electric, FirstCry owner Brainbees Solutions lists with a gain of over 40%. Unicommerce eSolutions too lists at a hefty premium of over 100%.
MSCI's August review sees India's weight in the global standard index rise with 7 inclusions and 1 deletion. But what draws more attention is a weight up for HDFC Bank in 2 tranches and the embargo on Adani stocks being lifted.
Alstom India's managing director tells Money Control that a 30,000 crore tender for 100 Vande Bharat trains has been scrapped as per the tender panel, and that's because they capped the price at 140 crore per train, which is less than Alstom's L1 bid. Good afternoon, you're watching us here on Halftime Report. I'm Manglam and with me today is Nigel. I know you guys liked us a lot in Chartbusters, so we thought why not give you an hour more of that. This is Halftime Report. And at halftime, as you can see, the market's down but not quite out. From the lows, we've seen a bit of a recovery on the Nifty, and barring the accident that we saw on HDFC Bank in today's trading session, all the other stocks are doing fairly well. The mid-cap index is in the green as well, and we see the advanced decline lines narrow, and currently they are split right down the middle. Hi, Nigel.
Well, that's right, Manglam. The heartening aspect today is the mid-cap outperformance, right? You have plenty of stocks that are up anything between 4 to around 8% odd. So that's good. And the contribution chart of the HDFC Bank stock actually will tell us the picture. HDFC Bank, the 20 DMA is at around 1,623 rupees, very, very roughly. And currently it's at around 1,610 odd. What's going to support the stock from here on is going to be that, $1.8 billion of estimated inflows in the first tranche. So in the near term, the stock will get some support out there. And, post-August, that's in September, then it gets back to its fundamentals for a couple of months. And then we'll be bracing for the tranche 2 of these inflows. So let's wait by for that. But Manglam, we've got a lot of companies on the show, so let's get straight to that.
Yep, let's do that. We have the first management on the show lined up for you. It's Supriya Life Sciences, posted a good set of first quarter earnings. Margins coming in at a multi-quarter high. The company's exports now contribute to nearly 80% of their sales. So to discuss this and more, we have with us Satish Wagh, who's the whole-time director and executive chairman of Supriya Life Sciences, joining in the stock, holding up with a gain of about 1%. Thanks a lot, Mr. Wagh, for joining in. The key takeaway that we have from the conference call is that you have 2 opportunities at an advanced stage in the CMO business, and CMO should actually start contributing from third quarter of this financial year itself. So on those parameters, I wanted your thoughts on, in this year, what could CMO be as a proportion of your overall revenue? And going forward, what is your target here?
So basically, I told you that we are working in the regulated markets. If you see the entire quarter, 80% is exports. And when we are doing in a regulated market, we are cutting the size on the products from the Chinese market. Wherever we are going to produce the CMO, CDMO activity, they are required worldwide because the current people who buy, all the companies are buying from the non-GMP plants. And we always say that we are a US FDA regulated plant of GMP, and it's a secured and a good sustainable product which will be delivered by the plant. So this is how we are very strong, but cannot give you the right the amount. But we will do our best because we are going to work with a good size of EBITDA margins.
By when does CMO become, let's ask you, by when does CMO become 20% of your revenue? And what is the target beyond that?
Sir, CMO, which we talk, CMO and CDMO, these are we talking with some therapeutic categories where all multinational companies are getting associated with us. So we will be working for them with a smaller amounts, but soon it will be very good, large amounts with them, and we will be a permanent supplier for those companies all over the globe.
Okay, all right. Hi, Dr. Wagh. And Good day, and thanks a lot for joining in here on CNBC TV18. Well, the
Thank you
street
very
is
much.
quite impressed with these numbers. And when you get a good start to the year, then it could be even more pressure. So give us a couple of numbers. For the year, what kind of growth will you be looking at, given that you have capacity that's coming on stream from the second quarter onwards? So for the year, on an average, what is the growth estimate that you're looking at? And margins have recovered to the high 30s. What is the range we should work with for this year on an average?
So let me tell you, I am in this business for last 38 years. A very matured person in the business and understands what is the exports and which are the therapeutic exports are required all over the globe. What I see in the future, let me tell you, these are the molecules which I am going to take away from China market. They are very big in terms of dollars. Billions of business is done by the companies who are manufacturing in China. So we stand today with a confirmed thing with everybody that we will deliver you from the audited US FDA and GMP-CGMP plant. That's the main thing which we are giving it to our customers.
Dr. Wag,
Yes.
Dr. Wag, we get that what you're saying, and I've gone through some of your con calls over the last couple of years. When you listed as well, we have a couple of interviews. So your vision is very, very clear. You're looking at grabbing market share. You believe that China +1 is up and kicking. But from a stock market perspective, they look at the share price and they would like to know what is the way ahead from here on. So last year you did around 570 crores and the year was a little bit volatile. The blended margins you did was around 30%. Now on that sort of a base, given the start you have to the year, the quarter one is very good. What should the growth number look like for the year? And margins from 30%, what does it move to for the year? Give us two numbers.
Sir, growth, if you see, is 22%. This year we have done. Last year we did. And this particular 22% growth which we have done for the quarter, we are confident we will deliver the same or better than this, which we expect.
Got it. Okay. So growth out of the way, 22, 23% at least. Margins?
Yes. Margins wise, we have this year delivered EBITDA of roughly around about 39%. We will definitely and confident to do in the future also the same one, because we have identified the business where we are going to hit the market. And today, the world is looking for those items because the GMP plants are not there at all in China, but they were forced to buy. So today, they're very happy that the source is getting moved away from China to India.
Wonderful. So 39%, what you've done in the first quarter, will you sustain for the next 3 quarters as well. So you'll end this year with 39% margins.
Yes.
Wonderful, Mr. Bak. You recently had a Health Canada audit as well in some of your plants where there was clearances that you got. So we just wanted to know how much in terms of a business can you get from Canada? And there is a second, there's a US FDA audit in the second half of this year as well. What plant is this at and what are you expecting here?
Sir, as far as Canada is concerned, that audit is over.
Okay.
The material has already moved to the Canadian authorities in the plants. It's a regulated product. So whenever regulated product, then it takes time. It takes minimum 6 months to 1 year for converting into the business. But things are moving in a positive way. And as I told you again, that the products which we are talking is required to the world from the GMP plant because they are helpless today. That's why they were buying. And I'm confident the products which we are going to manufacture will definitely give a better turnover, better performance and better EBITDAs.
Okay, so what do you mean by better EBITDAs? Because this year you will end with 39%. In the past, you've actually done EBITDA between 45 and 46% as well. This is the second quarter FY23 that we're talking about. So from a long-term vision standpoint, what do you see as a sustainable and an acceptable margin for you? Is it upwards of 40%, closer to 45%? Or you are happy with this 38, 39% so long as your revenue grows 20, 25%?
Sir, I'm not at all happy. We should get a better EBITDA. So we select and work with those therapeutic categories, and we always love to deliver better things to the market because the market needs today integrity and sustainable business person who
So
delivers.
when you say
as per
better
the
EBITDA,
requirement.
what is better EBITDA? Is it
Sir, it
45%?
will always see. It is always we cannot say the percentage, but it will always be a better EBITDA. That is as per the satisfaction of the market and as per the satisfaction and betterment of the company.
Okay, all right. Very quickly, sir, before we let you go, I recall that in FY23, you did revenues of close to around 460 crores approximately. And you said in the next 3 years or so, that's somewhere around FY26, there's a possibility you could double your revenues. Is that still on?
Yes, that is what is in my mind, and I will definitely try to do that.
So
My
900
two
crores.
operations will start. Let me tell you, I have two operations. One at my current site, where we
Yes.
already invested more than 100 crores. The
Yes.
validation and the standardization is going on. The another one is in Amarnath, the second site, where we have invested 100 crores. That
Yes.
also validations have started. I am confident
So-
both these plants will start working by October end.
So 900 crores of revenue target by FY26, given
Yes.
your capacity expansion. It's a
I
pleasure
will
talking to you.
definitely-
Yes, that's an aspiration as of now. For the time being, we'll hold you to the 22% for this year. Thanks a lot, Dr. Wag, for joining in. We get the China Plus One strategy, the way you're looking at the business evolving as well. We'll hold you to these numbers, though. For the time being, we'll slip into a short break. On the other side, another management is waiting for us, Jyoti CNC Automation. Stay with us.
Welcome back. Even as the Nifty is flittering between that 24,300 mark, a couple of stocks from the broader markets are doing extremely well. One of them is Honasa. Remember, yesterday it was down on account of the near-term inventory uncertainty that the street is looking at. But from a long-term standpoint, it is the best player when it comes to the beauty and e-commerce verticals itself. And that's not my words. Those are Goldman Sachs's thoughts on Honasa. In fact, they've said that the Indian beauty business may transform going forward, largely led by two major underlying trends. The one is that the shift goes towards e-commerce. The second one is that, there have been scientific, chemical and active ingredient-based beauty products which are doing well in the market. And Honasa benefits from that. They initiated coverage on the stock with a target price of 570. They have two broad levers for the company going forward. The first one is that, their other brands, which are the non-Mamaearth brands like of Dermaco, etc., will scale as high as Mamaearth at some point in time. And by FY27, they expect that, the offline reach will also double to 4 lakh outlets, and that will increase their overall presence and growth too. What are they expecting from now to FY30? You would see revenues growing to about 2.5 times what they were in FY24, and margins doubling from 7% all the way up to 14% as well. So those are the factors on which they're bullish on Honasa. Honasa is up about 2% today, Nigel.
All right, Mangalam, thanks for that. Well, let's focus on Jyoti CNC Automation then. We have with us Mr. Jadeja, the chairman and managing director of the company. Hi, Mr. Jadeja. Good morning and thanks a lot. Good day, actually, and thanks a lot for joining in. Well, the numbers are looking good. You've got a good revenue growth of around 74%, margins at around 26%. Clearly, things are moving well for you. For the year, what kind of a number can you guide us for? Can you keep up this sort of a momentum? And also tell us, how is ordering activity shaping up post Q1?
Yeah. So basically, thank you very much. The numbers are good in the first quarter. You are right there. And momentums are built up nicely over there. And we are looking, the momentums are we maintain the entire year similarly like that. And in terms of an order intake also, is let's say whatever the numbers of machines we have dispatched, similar orders has been come to our baskets, and almost we are at same order level booked are there for 3,400 crores to be like that.
So order book at around 3,400 crores as of now?
As of now.
Got it. And growth estimates in comparison to FY24, you're saying you'll grow by more than 70%? Extrapolating what you've done in the...
I'm not
Yeah.
saying like that, but let's say overall we will have a good numbers to be there.
Yeah, so
What is good numbers?
What is good, sir? You know, that's some part of the street could expect you to do more than 80%, while some would be satisfied with 50%. What will you be satisfied for, though?
So I'll be satisfied anything more than 40-50% there basically.
40-50%.
40-50%. So, you know, on your orders itself, you said your order book is close to around 3,400 crores and you've received as many orders as the number of machines that you've deployed. I just wanted to know what is the current number of machines that you have, because I remember you had this target to go to 6,000 machines by September 2024. What is the current number of machines and where does that go?
So basically right now the capacity up to the last year, our capacity was 4,400. And based on all our bottleneck been removed and up to September, we'll reach out to be around 6,000 machines. So with this 6,000 machines, our entire year, we are able to execute close to 5,400 machines this year, basically.
All right, so 90% utilization of 6.
Yeah, the capacity will be in place in
Typically, what is the throughput that you get?
third and fourth quarter to be there.
All right, typically, what is the throughput that you get per machine? You are expecting 40% plus sort of growth coming in this year. Per machine, what is the throughput that you generate so that we can then extrapolate, you know, as you increase the number of machines that would come into your revenue?
Yeah, so the last year, let's say by FY23, we were at average, our throughput was 27 lakhs per machines. That in 24 we are expected, let's say 24 we have touched to a close to 35, and this year we are planning to reach to we are expecting in between 45 to 50 lakhs per machine specifically.
Got it. All right. You know, given that you're having capacity that's coming on stream and your operating leverage will play out as well, is there an upside to margins from this 26% mark?
Little bit. There will be some improvement. We'll see in end of the year. Still from here.
So maybe around 100 basis points. Should we work with 27%, or will you be happier with more?
Definitely we'll aim to be more.
How much?
Maybe around 2 to 3% should increase furthermore, but we'll be with the 1%. It's absolutely fine.
Oh, so we'll work with around 28% on an average, right?
Average will be, I say that in nearby 25 to 27 in between.
25 to 27%. We'll take that then. You're giving us this band, but it appears you're sounding conservative. So for the time being, we take that. Also, the net working capital days, you had talked about reducing it. What will it reduce by? Reduce to by the end of this year?
Last year, we have reduced to from 336 days to 200 like that. And this year, we have reached to 170 days there. So further reduction, we are able to see that.
So 170 from 200 would be about a 30-day reduction.
230
and that came...
It's come down from 235 days to we are expecting to 170 days this year.
All right, that would be good. So that should aid your balance sheet as well. What is the current debt that you have? I remember you having a plan to become debt-free as well.
So almost today our net debt is zero today.
Okay, and gross debt?
Gross debt, we have a close to, let's say, is a 0.25, let's say 0.1% of our equity there. Basically.
All right. And what about order inflows? You told us that this quarter so far, you have an order book of 3,400 crores. With the incremental deploying of machines...
The total order book is today is 3,400 crores.
Yes. How much do you expect in terms of inflows for the remainder of this year?
So the based on our execution will be happen. Just the way the machine will dispatch, similarly order will come there, because now already we have reached to 1.5 years to 2 years of delivery period. Customer will not like to the orders in advance to be like that today. As in our this execution will increase, order we are also expecting to increase furthermore. So let's say this quarter we have close to 310 crores orders has been received.
Okay, so 310 crore worth orders was received in the first quarter or the second quarter?
In the first quarter.
And second quarter so far, how many have you received after elections?
So that we are, let's say we are expecting to touch this quarter is to be more than 400 crores to be here.
So that makes it 700 for the first half. Second half could be how much?
It's further money more there.
Second half is typically stronger than the first half, right?
It's a single very more.
If you have to put it in a percentage to it, it would be 40-60?
It's a 40-60. It's a 40-60.
40-60. Great. So approximately, Mangalam, by the end of the year should be around
3,000 crores in terms of, about 1,800 crores. 700 in the first half, and then you add another 900 crores.
So 1,600 crores for the year, sir. I think mathematically that seems to be the number.
It's a little bit more than that.
Little more, so 1,700. Okay, all right. And there's a trigger that the street was waiting for an Apple order. Any update on that front?
So basically, we are not to talk to that. Basically, it's a very.
But sir, as the street wants to know, so we have to ask you about that.
We are not able to tell you that basically.
But you're not able to tell us whether you're talking to Apple or whether the deal is happening or not happening.
So basically, we are greatly accepted in the EMS sector. Okay.
Correct.
And
by when, sir?
We received the orders from them basically.
Okay, Mr. Jadeja, sorry for coming in again. But by when can we hear about this outcome? Because the street wants to know that Apple order, when does it come in? Q2, Q3, or the second half of the fiscal we should keep it at for now?
So again, I'm telling you that that's very, in terms of, there's a very confidential parameters like that and a customer's name that, okay. So,
all right, so typically for large electronics...
Yeah, we are not able
let's not name Apple, but typically for large electronics manufacturers who've recently, increased their allocation towards India, what is the size of the order that you get from similar players? Not naming Apple, I just want to...
Let's say we are expecting another round of orders. We already have orders, and we are looking to be another round of orders in the next 1 quarter to come from them.
Okay, Mr. Jadeja, we need to press you on some of these points, but thanks a lot for sharing what you could with us. Whenever you come out of that confidentiality phase and this Apple order or any big order comes, we request you to join here on CNBC-TV18 so that our audience as well as your shareholders can get more color. For the time being, wish you all the best for the remainder of the year. Well, time to slip into a short break. You come back, we'll continue to focus on markets. Sachidanand Udekar is waiting for us with some trading strategies.
Watching us here on Halftime Report. Now, as we speak at midday, once again, we've seen a wee bit of sell-off for the Nifty, closing in towards the lower end of today's trading session so far, down about 1/3%. And it's the Nifty Bank which is pressurizing it, down 333 points, 2/3%. What is the common factor between the Nifty Bank as well as the Nifty Financial Index? It is HDFC Bank. Had it not been for HDFC Bank, today the Nifty would have been in positive territory by about 20 odd points. And even if you look at the Nifty Bank, the Nifty Bank is down about 333 points. The maximum contribution on the downside has come in from HDFC Bank itself. It's dragging it by about 480 points. So had it not been for HDFC Bank, both the Nifty as well as the Nifty Bank would have been in positive terrain. What is the impact that it has on something like the Nifty Financial Services? Well, the Nifty Financial Services expiry plays out today, and it is closer to that 22,800 mark. 22,800 put has the maximum open interest, and the 22,850 straddle, which is a call and a put together, has a premium of close to 75 rupees. So maybe the street believes that 22,775 could be an important support to track on the Nifty Financial Service, and on the way up, 22,900 of course would be an important resistance to watch out for. For the Nifty itself, the 24,300 mark remains a bit of a fulcrum. 24,300 call writers pretty active for a premium of 85 rupees. 24,300 above, closer to 24,350, 24,400, we may face some supply as we have been seeing over the last few trading sessions, but there is a lot of demand coming in at around 24,200. That's what the action at 24,300 call suggests, put suggests. Two stocks that I'm watching out for. Aarti Industries down 15% now. Huge surge in open interest, may enter F&O ban, and also we are seeing incremental open interest being added on Piramal Enterprises. So there is an outsized chance that Piramal Enterprises also enters the F&O ban.
All right, Mangalam, thanks a lot for that, and come and join me back into the studio to go ahead with the show. But for the time being, we have Sachidanand Udekar of Trade Bulls who joins us. Hi Sachi, good day, and after a while I'm speaking to you at noon. Tell us, what's the strategy? Buying the dip has worked out. Do you think today as well is a prudent strategy? Mangalam just told us that the markets are down 60, 70 points. Would you buy the dip?
Good afternoon, Nigel, and good afternoon, Mangalam. Clearly, I think the market is range bound, especially if you look at yesterday's price formations. Both the Nifty and the Nifty Bank displayed a spinning top kind of formation, which is again indicating indecisiveness. But if you look at the data, the Nifty Bank still looks much more weaker because it has been trending below its 20 and 50 both exponential moving averages. So I think the resistance for Bank Nifty is very clear unless we don't see it surpassing that 50,800 mark on a closing basis. The chances of revival are bleak, and probably we may see the Nifty Bank sliding lower towards that 50,000 mark again. So we are expecting that Nifty Bank may continue to underperform. There is fresh weakness which is evident in a couple of its constituents, and that's why we believe that if one has to short this market, then I think Nifty Bank still presents a very good reward to risk ratio. Keeping a stop loss somewhere close to around 50,560, one can still deploy short positions here. We may see it eventually swinging towards 49,800. But when we look at the Nifty, yeah. So when we look at the Nifty, I think the Nifty is still holding on to that particular support, and there's a good chance that we may see a good outperformance here, and probably a swing towards 24,200 would be an ideal opportunity to create some long positions. So I think looking at the equation, it is better to keep a long-short ratio when it comes to stocks. On the short side, I think SBI has been on the weaker trajectory. We have already seen a kind of a bearish flag formation on its daily scale. This particular formation is now mature. It is looking at a breakdown point at around 810. So once we see this particular level getting breached, the stock can easily slide towards 785. That is the positional target. So we are recommending building fresh short positions when it comes to SBI. The stop loss for the trade should be placed at around 820, a positional target of 785. On the long side, Apollo Hospital, I think it is about to come out with its earnings. But if you look at the overall trend structure, it is a classic bullish flag formation on its weekly scale. Even today, we have good strong signals of long built-up formations, and the support at around 6,600 has been working well. So I think keeping a stop loss somewhere close to around 65.80, some long positions can be deployed here. We may see an eventual swing towards 68.60. The pattern target for the flag is placed at around 7,000. So I think there is a good outperformance in this particular stock, which may continue.
All right, take that point. Thank you, Sachi, for joining in and giving us your view on the indices and the stocks. Take a short break. On the other side, we have another management lined up for you. The management of NCC joins in to discuss their first quarter earnings.
Welcome back. Well, the markets have moved to the low point of the day, so that's something that you should keep your eye on. We have an article, a news report coming in from Bloomberg, where Torrent Pharma may raise up to $3 billion to acquire the controlling stake in JB Chemical. So maybe both those two stocks should be in focus. JB Chemicals, I think, is the one that should come up for you on the screen. Let's see if we're seeing any kind of reaction, because there is a suitor. For Torrent Pharma, well, they'll be raising some capital. So JB Chemical, well, I think the street wants to first see the deal, and then, in fact, they'll take a call out there. As it is, the stock has gone up multiple times in the last 18 to 24 months. But as promised, NCC, that's a stock on our radar. The company's revenue and profitability grew on a year-on-year basis, but margins contracted a little bit. The order inflow is something that we'd like to focus on. To discuss the numbers and the outlook for FY25, we're joined by Mr. Sharma, the head of strategy at NCC. Hi, Mr. Sharma. Good day, and thanks a lot for joining in. Let's just revise the guidance for this year. Earlier, you were talking about an order inflow guidance of around 20 to around 22,000 crores. Do you hold on to that with revenue growth of 15% and margins closer to 10%? On these three numbers, do you want to tinker with the guidance given earlier?
Not at this stage. Very good afternoon. Not at this stage. These numbers have been worked out, after a lot of thoughtful analysis, and a lot of thought has gone into these numbers.
Right.
So as we speak, we do not intend to revise any of these numbers. We stick with the same guidance that we have shared with the street.
And from the first quarter performance, it seems like you're pretty much on target as well. The first quarter revenues have been around 5,500 crores. You have 3 quarters to get to that 22,000 crore mark on the top line as well. And even as the margins were just shy of that 9%, I'm sure that, with increased execution post the election related lull, you can go back to that 9.5 to 10% sort of margin itself. What we want to understand is the order inflow trend, because the first quarter, understandably, again, because of the elections, etc., your order inflow was just around 400 crores. In the second quarter so far, how many orders have you got? And what's your order inflow target for this year?
Yeah. 3 questions. let me first try to answer the first question that you put to me. The infrastructure business continues to be a government, business that is continue to be dominated by the government and government agencies. So whenever elections are announced, there is generally a freeze on award of orders. So that is the reason the number that you get to see, that is, 400 odd crore, appears to be a little less number. That I fully agree with you. But when we had the last conversation, I think I shared this point of view with you that, the awards are expected to be a bit lull in the first quarter. That said, we continue to, the second question, about the awards that we have received in the second quarter. As we speak, we have still not received any award. But we have already shared in the call that we have had a couple of days back that we are L1 in few projects, and we are quite hopeful of, converting those LOAs into LO order awards, very soon. The third question was about your about order inflow guidance. The guidance that we have shared with the street is 20,000 to 22,000 crore, and we continue to stick with the same target as we speak.
Okay. All right. So 22,000, got that. Mr. Sharma, you mentioned that you're L1 in a couple of projects, and that's what's giving you this optimism that you can convert this into the 22,000 order inflow guidance that you've given. Quantify the L1 positions as of now?
It would be close to 8,500 crore.
And what is normally your conversion ratio?
It depends, at the end of the day, this is a call that, our client has to take. And it's a reasonably high degree. And even if I just try to extrapolate that, other than that also, we continue to see very healthy pipeline of projects which are expected to come up for bidding in the next couple of quarters. Even if I were to accept the proposition that they do not get converted into final orders, we have a very strong pipeline of projects which are coming up for bidding. And we are quite hopeful of, finally hitting the number that we have shared with the street.
So L1 is around $1 billion, 8,000 crores approximately. And
That's right.
You said that the pipeline is also strong. You want to quantify that you all are going to be looking at bidding?
The pipeline that we get, we see currently would be close to 2 lakh crore. But, as I have shared with you,
Right.
It is it's the decision-making cycle of the client. There are clients that, take a little more time to really, start the process of bidding. But we are hopeful. And I reiterate that we do not see any reason as we speak to revisit these order inflow guidance numbers.
Obviously, with a 2 lakh crore bidding pipeline, even if you get 10% conversion ratio, you are getting that 20,000 crore mark in this year itself when it comes to order inflow. One of the things that the street is excited about is the opportunity in Andhra. There are talks of a multi-billion dollar capital city being built out there. You are based out of there. Some believe that you're well placed to get some orders from there. So when you say that 2 lakh crore, do you include this also in it? Or there is a separate number that you have ascribed to this? And also, do you have any pending claims from the earlier orders that you have from Andhra?
We have some, little bit pending claims, and that we hope
much would that
to get,
be?
those claims. It would be close to 150 crore, and we are quite hopeful of, getting that payment back in about next couple of months' time. The
And,
first part of your the first part of your question was about the possible awards from this state of AP.
yes.
We have initiated the discussion with the clients, and we understand that they are also trying to evaluate the finer nuances of restarting the project, how to award the contracts, when to award the contracts, how to fund the projects. We believe that these discussions are actively going on at the client's end. And we are as eager as you, to really, to start bidding for these projects.
All right, Mr. Sharma, you're sounding reasonably confident about the way ahead. But before we let you go, we wanted to ask you about the smart metering opportunity. You already have two projects, I understand, of around 8,000 crores in Bihar as well as Maharashtra. What is the further update on that, and how large is this opportunity for you?
We have three projects really for the smart meter. The total order value would be about 8,000 crore. Two projects are from the state of Maharashtra. The order value of these two projects from the state of Maharashtra would be close to 5,700 crore. The third project that we have bagged is from the state of Bihar. The value of that project is close to 2,300 crore. So all these projects are, making reasonably good progress. And, in the Bihar project, we have already started the trials of the meters. So these projects are making very good progress.
What we wanted to know is that, are there any other states which are likely to give you those orders as well? Now that you've proven your capabilities in both Maharashtra and Bihar, along in the three projects that you have there.
It would take some time. It would take some time because of the elections, this has not been a priority for the different state governments, agencies of the state government. But we believe the whole process would restart in about a month's time or so.
So then where is this optimism of 2 lakh crore pipeline coming from? Because smart meters, you said that this will take time. Amravati obviously will take some time as well. So this 2 lakh crore pipeline that you have, what kind of orders are these?
Primarily, it would be, we have four large businesses: the buildings, transportation, electrical T&D, water project. Then we have relatively small divisions: irrigation, mining, and railways.
Right.
The projects, all the projects that, but that said, let me take this opportunity. These are the pipeline of projects, prospective pipeline of projects. What it essentially means is these projects have been, announced by the different government arms, and they are trying to finalize what is the right bidding pattern, the funding pattern. So those details are something that is being worked out by our clients, and it will take some time, for us to really see for these projects to see the light of the day.
Got it. All right, Mr. Sharma, thanks a lot for joining in. Revenue growth of 15%, margins of 9.5 to 10%, order inflow of around 20 to 22,000 crores with a massive order pipeline. Appreciate you joining in. Stocks still holding more or less flattish, but the markets have moved to the low point of the day. Take a snappy break, come back. We'll continue to focus on markets and stock-specific action.
At the low point of trade today, and as we speak, we have a bunch of stocks which are lower. But let's talk about Hudco and IRFC. Their stocks in focus on the back of their first quarter earnings. Vamakshi joins in with the details of these two. Vamakshi.
Well, absolutely. It's a good set coming in for Hudco. When you look at the disbursements, they came in at 12,625 crores. This is a huge uptick of almost 19 times on a year-on-year basis, and this growth is largely being led by their urban infra disbursements. Loan book resultantly saw an uptick of almost 30%, and with that kind of growth, they've actually managed to surpass what the street was largely expecting. NIMs, however, came in at 3%. This is lower as compared to their guided range of 3.1 to 3.3%. It has also seen a contraction both on a YOY as well as quarter-on-quarter basis. NII saw an uptick of almost 12%. PPOP, that is pre-provisioning operating profit, saw a gain of almost 16%, and net profit for the company came in nearly 25% higher. Moreover, we also saw the asset quality improve. GNPA stood at 2.42%. This is an improvement of almost 29 basis points sequentially, and NNPA too improved by almost 3 basis points sequentially. So overall, it looks like a good set for Hudco, and as a result, the stock is reacting to a positive set of numbers. IRFC, on the other hand, reported a decent set. NII came in nearly 2% higher. PPOP came in nearly 2% higher as well, and the company reported a provision write-back of nearly 3.6 crores as compared to provision of 50 lakh crore on a sequential basis, and the net profit also was nearly 2% higher. So overall, decent set for IRFC as well.
Okay, all right. Thanks a lot for that. But let's focus on another stock. We have Aarti Industries that's taken smack today. Sonal joins us to help us out with a quick analysis. Sonal?
Well, you know, Aarti Industries is one company which spoke about sequential recovery much ahead of other chemical names. And that is something that made the street quite positive on this particular company. But now when we talk about the FY25 guidance, they're not very sure if they'll be able to achieve that 1450 to 1700 crore rupees of EBITDA guidance, because they say they are seeing volatility in margins. There's also pressure coming in from China in terms of pricing, and that is something that has taken the street by surprise. They do indicate that volume growth will continue to be at that 20 to 30% mark. The discretionary segment, which is a big part for their business, continues to do well. There is sequential recovery in pigments and dyes. However, agrochemicals recovery will come by only in the second half. They also talk about how Red Sea crisis has impacted global freight rates, and that is something which could impact volumes in some of the segments that they operate in. Debt stands at 3,300 crore rupees. They expect it to continue to be at those levels of 35 to 3,600 crore rupees. As I said, it has taken street by surprise. Morgan Stanley says they are evolving their product mix, getting into energy applications. That is leading to more volatility than what the company has seen earlier. They have a target price of 615 rupees a share. MK has a buy with a target price of 800. Yes, it is the fourth consecutive quarter of sequential recovery. However, they've gone ahead and cut EPS estimates on the back of this uncertainty on EBITDA guidance. Nuvama is raising target price, but that is because they are rolling over their estimates to Q1 FY27. They retain a buy rating. Kotak says the company has suspended FY25 guidance for EBITDA. They retain their sell. Even management has indicated that long-term growth will be 20 to 25%, but Kotak says even that depends on a lot of things like global demand, pricing pressures, and the China factor. So that is something that they'll be closely watching out for.
All right, Sonal, thanks a lot for that. So that's about Aarti Industries. Meanwhile, take a short break, come back, get you more on the markets and a lot of other stocks on the other side.
Welcome back. The Nifty is down close to under 100 points, but the Nifty Bank is the one that's doing a relative underperformance today. In fact, that's down close to around 500 points as we speak, courtesy big boy HDFC Bank. Let's pull up a sectoral contribution for you on the screen. The ones that are underperforming today is the Nifty Financial Services Index. That's the one that plays out the weekly expiry today. So keep an eye out on that. The bulls will be hoping that at some point of time we see a bit of a recovery. For the time being, that's not in sight. Metals as well are pulling back. That's down close to 0.7%. Data coming out of China isn't great. But the place to hide today for the bulls is healthcare as well as pharma. Both those two indices up 0.2 to around 0.3%. Throw in there the tech space as well. That one as well is higher. But that's it from Mangalam and myself and the entire team of Halftime Report. You stay with us though. Business Lunch comes up next.